Welcome to lesson 8.3 for financial algebra. This one is the mortgage application process. We got quite a bit of vocabulary on this one, so let's just jump to it. How about that? All right, first vocabulary word we have here is market value. Now, this is how do you determine market value? This is when a willing buyer and a willing seller agree to a price. It's the amount that a willing buyer will pay and a willing seller will sell for. That becomes the market value. So it doesn't matter how crazy you think that thing is priced, when somebody agrees to buy it, that instantly becomes the market value. Next vocabulary word we have is property tax, also known as real estate taxes. This is the amount that a homeowner will pay annually, and it ranges between 1 to 4% of the purchase price depending on what golden state you're in. By the way, in the IRS section, when we start doing the taxes, property taxes are a deductible portion of your tax return. All right, next vocabulary word is the assessed value. Now, this is the value used to determine the amount of property taxes a homeowner will pay. So you may have a market value where a buyer and seller agree to a price, but then the assessor's office is going to come in and use that market value and determine an assessed value, and then that assessed value is used to determine your property taxes. Next vocabulary word we have is down payment. This is the amount of money that a buyer must put into the transaction in order to qualify to borrow the rest. There is no such thing as a down payment when you are renting a property. The down payment only applies when you are purchasing a property. And this is your skin in the game. This is what keeps you accountable to making sure that your payments are made on the amount that you borrow because you put some money into the transaction. It's the bank's little bit of leverage that they have to ensure that you continue to make your payments so that you don't lose the money invested. Next vocabulary word we have is a mortgage. This word, by the way, means a contract until death. But just saying, throwing that out there. All right, mortgage, the actual vocabulary word, means a borrowed amount of money financed over a period of time to purchase a property. So most people don't have the $550,000 in cash that you need to buy a home here in San Diego. So they put a down payment and finance the rest using a mortgage. Even though the state of California, we actually use trust deeds, we don't actually have mortgages. A mortgage is a common term that we use to describe the loan being borrowed. All right, so the next vocabulary word is a fixed rate mortgage. This is a mortgage in which the monthly payment and the APR remain the same throughout the life of the loan. So you can get a 15-year fixed mortgage or a 30-year fixed mortgage, and the payment and APR will stay the same throughout the length of the loan, all either 360 payments on a 30-year or 180 payments on a 15-year mortgage will be exactly the same. Next vocabulary word we have is an adjustable rate mortgage, also known as an ARM. This mortgage, which is in which the monthly payments and APR may change, and those changes are specified in the signed agreement. So ARMs are one of those creative financing things that got a lot of people into trouble in the 2007 boom and bust of the real estate market. People couldn't afford to buy the high-priced homes. So the banks offered a creative financing where you would have a fixed rate for a short period of time, maybe 3 years, 5 years, 7 years, 10 years. And after that, the interest rates would adjust, thus adjusting your monthly payment. And people couldn't afford to make those payments, and they walked away from their mortgages, especially when the real estate market turned and they owed more than their home was worth. So they had more of an incentive to walk away, and it made a big downward spiral for the real estate market at that time. So make sure you understand what kind of mortgage you're getting into, whether a fixed rate or an adjustable rate. Next vocabulary word we have is foreclosure. Now, let's assume, just like in the previous example when we were talking about people who walked away from their mortgages, means that they stop making payments. And when that happens, the bank takes possession of the home that was secured by the loan due to the owner defaulting on the mortgage payments. So you stop making the payments, the bank needs to recover the money that they lent you, the loan that they lent you, the mortgage. So what they do is they start the foreclosure process where they legally take possession of the home, they turn around, put it on the market, and sell it to recover the funds that you borrowed. They may lose some money on the deal, they may make some money on the deal. If they make money, they'll send you a check for the difference minus the fees for the foreclosure process. If they lose money, they'll send you a 1099 saying that this is the amount of money they're writing off as a loss, which means you need to claim it as income. So the foreclosure process could suck on all sides. But it still happens. All right, so next vocabulary word we have here is the homeowners insurance policy. Now, this is insurance that covers damages to the house due to fire and other natural disasters. It may also cover contents in theft or vandalism. Now, homeowners insurance is not required by law, but it is required by the lender who gives you money to borrow. So if the bank is lending you money on a home, they're going to require that you have homeowners insurance policy in case something happens to the home. The insurance policy will pay to rebuild the home, because remember, they're lending the money to on the asset, not really to you. Yeah, they're checking if you qualify, but the value of the loan lies within the home, and they know that, so they make sure that they have an insurance policy to cover it. If you own your home free and clear, you don't have to have homeowners insurance. Probably a good idea to still have it in case something happens, but you don't have to. So make sure you understand homeowners insurance is there to protect you in case something happens, and it definitely protects whoever's loaning you the money, which is why it's a requirement. All right, escrow is our next vocabulary word. Escrow is a third uninterested party that holds and disperses funds according to the contractual agreement. So escrow is like if you have two people who are, one's trying to buy, the other one's trying to sell, and neither of them knows, trusts, or there's no trust there because they don't really know each other anyways. And even if you knew each other, you want to make sure that everything goes as smoothly. So they get a third party, this is escrow, and all the money goes to that third party. All the contracts go to that third party. The third party then sorts out what's going on in this agreement and then sends back the title to whoever is buying the property and the funds to whoever sold the property. So escrow is a third uninterested party that holds and disperses funds according to the contractual agreement. All right, how do we even know if we qualify to buy a place? That's our next vocabulary word. We have a front-end ratio, and just understand that for this one, your front-end ratio should be less than 28%. So first you got to understand what a ratio is. A ratio is nothing more than a fraction. 1 to 2 is a ratio. That's 1 over 2. And in this case, our front-end ratio has our monthly housing expenses divided by our monthly gross income. And so we use a front-end ratio to help calculate, to determine whether you have the ability to even borrow, right? And understand that when we do take the monthly housing expenses, we divide them by your monthly gross income, and we get a decimal that is 0.28 or below, so like 28 cents or below, then you're qualified. If it's more than 28%, you're not going to be qualified to buy this home. Now, front-end ratios are important, but back-end ratios, which is our next vocabulary word, back-end ratios, also known as our debt-to-income ratio, our DTI, this is the one that the lenders tend to use more often, and it generally should be less than 36% for a mortgage approval. Now, I have people in the lending world, and we have different lending products. 36% is a generalized number. I've seen stuff as high as you have to have less than a 55% debt-to-income ratio. That's outrageous, but still, sometimes that happens. So check with your local lender if you are interested in getting some pre-approval set away here. But how do you calculate the debt to income ratio? This is your total monthly expenses, and we're talking about all your debts. So this is car payments, this is school loans, this is mortgages, these are any of those debts, whatever the debt obligations are that you're required to pay. Those total debt amounts divided by the monthly gross income will give you your debt to income ratio. The formula is written right there in the name, debt to income ratio. And in general, if you're less than 36%, you're good to go. But every lender is going to have its debt to income ratio limit, and so make sure you meet or be below that amount if you're looking to borrow using a mortgage. All right, next vocabulary word we have is balloon mortgage. Now, a balloon mortgage is designed so that you have very small monthly payments for pretty much the life of the loan, except for that last payment. That's going to be a very large payment, a balloon payment. So a balloon mortgage is lowered monthly payments that are achieved by having very large final payments. So one of the ways we calculate that is we figure out, well, actually, you know what? We're going to do that in some of these other problems. But we figure out what the interest is on an interest-only section. We break up that interest-only payment over the life of the loan. And then the very last payment, we pay back the last little interest payment plus the entire amount that you borrowed. So if you're borrowing $200,000 and it's a balloon mortgage, chances are you have very, very small monthly payments, and then your last payment is going to be like $200,000. So, not a very good way of doing it, but there are reasons why you might want to use a balloon mortgage. Beyond the scope of this course for right now. All right, next one, last vocabulary word is interest-only mortgage. And this is little to no principal being paid on a monthly basis for a designated period of time. So when we were talking about adjustable rate mortgages, usually they have a fixed period of time, 3, 5, 7, 10 years. And during that time, you're only paying the interest part. Little to no of the principal is being paid. And then after the adjustment period is over, that's when we adjust, and now you start paying back on the principal. But because you haven't been paying down that principal, those payments could be larger, first of all, because you're paying the principal portion back. And then on top of that, the interest rate could be adjusting, which means you're paying more in interest after the adjustment period. So those are interest only mortgages where you're only paying the interest part on your monthly payment. Next, we got checking for understanding example number 1. Now this one's got a pretty meaty formula, so let's work through this one. So Mila wants to buy a home and has saved a down payment. She finds a home and she will need to borrow $190,000 with an APR of 6.4% on a 30-year loan. So how much interest will she pay after 30 years? Alright, so what we need to do is we need to figure out the monthly payment. So if you look back in chapter 4, they give us this formula. M is equal to P times R over 12 times 1 plus R over 12 raised to the 12t power divided by 1 plus R over 12 raised to the R times 12 power minus 1. It's ugly, right? But the substitution part is simple, and if you use a graphing calculator, it makes things that much easier. So the things we need to understand is that the thing we're solving for here is the monthly payment. We're going to input the principal, we're going to input the interest rate expressed as a decimal, we're going to convert into a decimal, and then the number of years, and let the calculator do the hard work. So once we put in the information into the graphing calculator, right, I'm going to write out the formula here, 190,000 times, make sure we convert this rate into a decimal, 0.064 divided by 12, quantity, open up another parentheses, 1 plus 0.064 divided by 12, close that parentheses, raised to the 12 times 30 power, all that divided by 1 plus 0.064 divided by 12, close that parentheses, 12 times 30, exponent, minus 1. Alright, so now you have it there, so you can input that into your calculator, and when you do figure out the number, it's going to come out to be $1,188.46. Now this is an approximation of the monthly payment, and understand that this monthly payment consists of both principal and interest. So if I take that monthly payment of $1,188.46 and I'm going to multiply it by 360, because that's a 30-year mortgage and each year has 12 payments on it, so that's 360 total payments by the time I pay this home off. And if I do that, I come up with a really big number, $427,845.60. Now I want you to think about that for a second. Mila only borrowed $190,000. But when she pays back this loan after 30 years, she's going to have paid $427,000. That's a lot of money. So, understand what happens when you're borrowing these funds, and why paying your house off as quick as possible is going to save you in the long run. So anyways, how much of this did the bank earn, and how much of it did you pay back? Well, if you paid back $427,845.60 after 30 years, and you subtract out the amount that you borrowed, which is only $190,000, it means that you graciously and thankfully paid the bank $845.60 for 30 years. The bank made more than twice what they let you borrow, and you said thank you because you don't know the rules of the game. But now that you do, you're going to play the game a little different, right? I would if I were you. Alright, example number 2. Checking for understanding. Now in this spot, we're going to figure out how to calculate basically the assessed value of a home. So we have two different tables that we're looking at. Well, one table that we're looking at here and one description. So first let's look at the table. The table breaks down structural rates per square foot, and then it has some flat rates. So for example, on the left hand side, if the first floor has a basement, it's $3 per square foot. If it's a slab, then it's only $2.25 per square foot. If it has a second story, then it's $2.25 per second story square foot. If it has a garage, it's $1 per square foot. A dormer, a barn, a deck, a shed, a vinyl lined pool, all that has a different rate. And we're using these rates to calculate the proposed tax value, the proposed tax for this particular unit. And on the right side of this table, we have flat rates. So if it's for the land, it's $1,000 per acre, right? And we prorate that. If it has a bathroom, the first bathroom doesn't cost anything, but each additional full bathroom is $100. If you have a half bath, meaning that there's no showers, just a toilet and a sink, right? Then that's $50. If you have a fireplace, $125. If your place has a tennis court, that would be awesome, but they tax you for that. A spa, central air conditioning, gas, heat, all that stuff. So they're calculating the value. Now below that we have the description of the actual place, right? So it's a 2-story colonial, 2.5 bath, has a fireplace, full basement, right? 30 by 30 deck. It has a 1/4 acre, 600 square foot on the first floor, 1,500 square feet on the second floor. It has a 20 by 20 foot dormer, 12 by 21 foot garage, 16 by 32 foot vinyl pool, gas, heat. It's in excellent condition. It's listed at $289,000. All right, so what are we going to do here? We're going to break down what this piece has. So on the first floor, it's going to have 600 square feet times $3 is $1,800. On the second floor, it's 1,500 square feet at $2.25 a square foot. That's $3,375. The dormer is 20 by 20, so it's 400 square feet at $1 per square foot. That's $400. The garage is 12 by 21, which is 252 square feet at $1 a square foot. That's $252. The deck is 30 by 30. That's 900 square feet at 50 cents a square foot. That's $450. The pool is 16 by 32, which is 512 square feet at 75 cents a square foot. Is $384. The land is a 3/4 acre lot at $1,000 per acre. That's $750. It's got one extra bathroom. So it's got 1.5 bathrooms, so it's $150. It's got a fireplace, $125. Air conditioner, $200. Gas, heat, $700. So if you add all those assessed values up, the assessed value is going to be $8,586 in taxes that we're going to pay. Now this particular county says that the tax rate is 89% of the assessed value. So if we take that $8,586, multiply it by 0.89, we find that the property tax on this house is going to be $7,641.54. Example number 3. All right, so let's move on. I know that was a big one, right? All right, so example number 3. Mila and Liam have a mortgage with an impounded account. Their monthly mortgage payment is $1,233.56. Their semi-annual property tax is $5,206. Their annual homeowners insurance bill is $1,080. What's their total monthly impounded payment? Now you got to understand what an impounded payment is. So in banking, oftentimes they want to make sure that you pay the insurance and you also pay the property taxes. So when you get your monthly mortgage payment, it not only includes the principal and interest portion that you're paying the bank, it also breaks up the property taxes into annual payments, into monthly payments, and it breaks up the homeowners insurance into monthly payments and combines all the monthly payments together. That's one impounded account. The money that goes for the homeowners insurance and the property taxes is held in escrow. Remember, that's a third uninterested party. And when your property tax bill comes due, escrow pays the property tax. When your homeowner's insurance policy comes due, escrow pays the homeowner's insurance policy. So that third uninterested party collects all the money and pays out whoever needs to be paid out. All right, so in this example, we need to break some stuff up into monthly payments. We know their monthly mortgage payment is $1,233.56, but their property taxes and their insurance bill is broken up into annual or semi-annual. So let's start with the insurance. The insurance is $1,080. If I divide that by 12 months, it means that I need to allocate $90 each month towards that bill. And then the property taxes Those are semi-annual property taxes. So we're going to take that $5,206 and we're going to divide it by 6, and that gives us $867.67, and that's our monthly part that's going into escrow. So if we add all those things up, $1,233.56, $90, $867.67, that's a total monthly payment of $2,191.23. That's your actual monthly payment, including taxes and insurance. This is called PITI, principal, interest, taxes, and insurance. Now, just so you know, when you see stuff like Rocket Mortgage or Quicken Loans advertising a monthly mortgage payment, they're usually only advertising you the principal and interest portion. They're not advertising you the taxes and insurance, which you are responsible for, but it's just much better to market $1,233 versus $2,191, right? Which one would you want to buy? Of course, you're going to go for the $1,233. But just don't be mistaken. Understand what it is that they're selling you ahead of time. Okay, so $2,191 is what you're actually responsible for, but the marketing might be for the lower amount. All right, example number 4. So in example number 4 here, Mila and Liam are thinking about buying a home. Their AGI is $135,511. Now it's per year. AGI is adjusted gross income per year. The monthly mortgage payment for the house they want is $1,233. That's nice. The annual property taxes would be $9,400. That's annual, right? And the monthly homeowner's policy is $876 per year, another annual dollar amount. So will the bank lend them the $190 to buy the house? So here we're going to have to use a front-end ratio. So we're going to take the total monthly housing expenses and divide them by the gross income, and if it's less than 28%, we're good to go for this example. So we need to take the property taxes first of all, because those are annual. So it's $9,400. We're going to divide it by 12. That's going to give us the monthly of $783.33. We're going to do the same thing for the insurance. The annual insurance rate was $876, and we divide that by 12. That's $73 a month. And we're going to take the monthly gross income and calculate that. So we're going to take the $135,511 that they earned together, divided by 12, and that's going to be $11,292.58. And now we just got to do the front end ratio. So we take the monthly housing expenses, the $783 for the property taxes, $73 for the annual insurance, plus the $1,233 in mortgage, principal, and interest. We add those together. It comes out to be $2,089.33. Divide that by the gross monthly income, which is $11,292.58, and we get an approximately 0.185 or 18.5%. Since it is less than the 28% front end ratio that we need, the bank is probably going to lend them the money that they need. That's example number 4. All right, let's move into example number 5. All right, example number 5. Well, Mila and Liam again. And Liam told me I should use other people's names, so we're going to use Eddie and Alyssa for this one. Just hypothetical, okay? So Eddie and Alyssa need to figure out what they can afford when thinking about buying a home. Their AGI is $166,988. Their monthly mortgage payment... Oh, you're welcome, son. See, you got a thumbs up there. The mortgage payment on the house they want is $1,544, and the homeowner's policy will be $1,007 for the year. They have $510 monthly car payment. They have a monthly credit card bill of $5,100. Will the bank lend them the $210,000 that they need? So we're going to use what's called a back-end ratio for this one. We're going to use the debt to income ratio. So when we calculate the monthly expenses, not only are we going to calculate the monthly expenses, we're going to also add in the debts here. All right, so let's break this down. Some of this stuff is annual. So the homeowner's policy, for example, is $1,007. We need to divide that by 12, and it'll give us the $84 a month monthly payment. Same thing with the property taxes. $9,888 divided by 12 is going to give us $824 a month. So those are our 2 monthly expenses that we need to add in here. So the mortgage is $1,544. The property taxes are $824. The homeowner's insurance is $84. And now we got to add in the debts. So the car payment is $510. The credit cards are $5,100. Brings the total monthly expense to $8,062. Now, they make $166,988 per year. Divide that by 12, we end up with $13,916 per month that they're bringing home. So we divide the total expenses of $8,062 divided by the monthly income of $13,916, and we get an approximately back-end ratio of 0.579, or approximately 58%. Now remember that to borrow money from the bank for this home loan, they have to have a debt-to-income ratio of less than 36%. And in this case, they have 58%. So the bank is not going to give them a loan. If they could pay off their credit cards, right, and save those and not have that $5,100 a month obligated to credit cards, then they would be more likely to qualify. But in this example, having that $5,100 in monthly debt is eating away their ability to borrow more funds, because they've already borrowed them in terms of credit card, so the bank won't lend them the money. All right, that's the end of example number 5. Let's move over to our final example, example number 6. So Liam is opening a fast food place. He takes out 6.1%, 15-year, $300,000 mortgage on the building. But since they're spending everything they make right now to get the business started, they need a loan that allows them to make the minimal payments up front. They plan on being able to pay in a few years once they're established. So how much would they pay in interest for the entire loan, and what will be the monthly payments on that interest-only loan? Alright, so we're going to have to incorporate an interest-only loan here and a mortgage, balloon mortgage payment. So here's what we need to do. We need to take this formula that we used earlier, and we're going to calculate the monthly payment on this particular loan. So we plug in the principal of $300,000, the interest rate of 0.61, which is at 6.1%. We're going to do this for 15 years. And when we plug this into the formula, I'll give you time to write it. It's 300 times 0.061 divided by 12, close parentheses, open the parentheses, 1 plus 0.061 divided by 12, close the parentheses, raise it to the 12 times 15 power, divided by 1 plus 0.061 divided by 12, close the parentheses, raise it to the 12 times 15 power minus 1. All right, big old formula, right? Okay, so when we plug that into the calculator, we figure out that the monthly payment on that is going to be $2,547.81. But remember, that's principal and interest, and Liam's trying to get his business off the ground, so we're going to structure this payment a little bit different. So remember, this is a 15-year mortgage, so 15 times 12 is going to be 180 monthly payments. So if he pays $2,547.81 180 times, by the time he's done paying off this mortgage, he would have paid $458,605.80. Now, he borrowed $300,000, so if I subtract $300,000 from that, I find that he paid $158,605.80 in interest. So let's structure this loan so that he's paying the interest-only portion for the life of the loan with the balloon payment at the end. So if there's 180 payments, I'm going to take the interest portion, that $158,606, and I'm going to divide that by 179, because the very last payment, the 180th payment, that's going to be a balloon payment for $300,000. The last payment is a huge payment, but every payment up until then is going to be only the interest broken up into 179 times. So 158,606 divided by 179 comes out to $886.07. So Liam borrowed $300,000 to start his restaurant, and on a month-to-month basis, it's going to cost him $886.07. He's going to do that for 180 payments for 15 years almost, and then in the last month, he's got to make a balloon payment of $300,000. Now, understand that for the most part, people don't take these loans as far as the 15 year, and banks probably won't structure it this way anyways. Usually what will happen is they'll set it up for a 5, 6, 7 year, 10 year term, and then during that time when Liam's business is picking up, he'll refinance that loan. In other words, he'll start it all over and set it up so that he's paying a principal portion, and that balloon payment is rolled into the monthly payments going forward. So there's a different way of, this is just a book example of how it works, in real life, there are many flexible options how we can structure these types of deals. So if you want to learn more about lending, there's a ton of stuff that you can learn from, and a little bit of experience, so that when you do get into the market of buying a home or financing a business or whatever it is, you have an understanding of how these payments work and what the dollars that you are paying are going towards and where they're going. So, as always, at the end of these shows, I like to plug our podcast. You can visit our podcast on iTunes. You can see it on Google Play, anywhere where you listen to podcasts. So, our podcast is called Business Bros. Go ahead and check it out. And if you have any questions on any of the content that you're hearing here today, you can send me an email, hernan@csfirst.com. But that's all I have for you guys. Hope you enjoyed this lesson. 8-3, the mortgage application process. Peace, and I'm out.